Okay, now remember, we're talking about the retirement fund bucket. This is really what I'm focusing on here. So I want to talk to you about retirement plans because a lot of people get confused about, well, what are my options? Taxes are going up. They're not going down. So retirement plans, putting money away in a retirement account for taxing later, is still what we want to do, and in fact more important than ever. Now, don't get excited here with the stuff going on saying that Obama's going to max out what you can put in your retirement plans and then you can't put any more in or you're going to get taxed. Put that out of your mind. That's not going to happen. And what they're talking about is almost $4 million for your lifetime. So it's not going to pass. Put it out of your mind. Let's talk about the types of retirement plans. There's basically two types. There's something called a defined benefit plan, and there's one called a defined contribution plan. Now, these are types and not plans. They're really two distinguishable types, and we'll talk. And there's also something called a mega plan. Okay? So, defined benefit plan. It's one plan. It has actuarial calculations of the computations that have to be made every year as to what you can put in to the plan as a maximum every year. It's based upon salary, age, 1 year of service or more, whatever your plan says, and full-time employees. Okay? You must make a contribution every year. It's not optional to skip a year and come back the next year. You can freeze it and reactivate it after several years, or you can terminate it. But you cannot say, I don't have the money this year, maybe I'll pick it up next year. Cannot do that. In a defined benefit plan, you must make a contribution every year or freeze it. A great defined benefit plan means that 70% or more of all the dollars and the contribution every year are going to the doctor and your spouse. If you've got a plan that does that, you've got a good plan. If it's less than 70%, it's not a real good plan. Okay? You may be able to contribute from $45,000 to $150,000 and maybe a little bit more than that every year. So it is the type of plan where bigger dollars can go into the retirement plan. Okay? But it does cost more. Their fees are a little higher because calculations have to be made. So those are that's a defined benefit plan. It's a defined benefit when you reach a certain age. That's why age is very important in their calculations. If you have employees that are 65 years old, you're going to be putting more away annually for that employee than you think, but as long as your salary is at a certain level and it's much higher than what those people are getting, you're still going to get the majority of the dollars, okay? Now, we're going to switch gears and talk about defined contribution type plans. Defined contribution means that every year you know exactly how much you're going to put in, okay? And you can change it every year, but you know it's a contribution for that year. It's not based upon age at another level or when you're going to reach your retirement age. It's the plan amount this year that you know what it's going to be, and it's for that year. It has nothing to do with when your retirement age is. So there's several types of defined contribution plans. There's 401k plans where you can put in $17,500 a year, and if you're 50 or older, you can put another $5,500 in. There's SEP IRAs, which max out at $51,000 a year. There's a simple IRA, which is $12,000 a year, and if you're 50 years or older, you can put another $2,500 away. And there's a profit-sharing plan. A profit-sharing plan, I did not put the maximum because it actually has to do with a percentage of the profits that you have in the business for that year, and it varies quite a lot. So those are defined contribution plans. It's for a specific year that you will know the contribution amount. Has nothing to do with when you reach retirement age. It's that year, and you can skip a year. You don't have to do it every year. So I talked about something called a mega plan. There is an option if we're really trying to get every last dollar into retirement plans, and I'm telling you, now is the time. We want to bring income down. There are so many nasty extra taxes going on as income creeps up. Now's the time to think about these extra retirement plans. So a mega plan, you can do a 401k with a profit sharing. That's common, and a lot of people are already doing this. You got the 401k, which means part of your salary and your W-2 is being put into retirement plan every pay period. And then you've got the profit sharing, which is an amount that you can put in up to September 15th of the next year based upon the ultimate profit for the prior year. 401k plus profit sharing plus a defined benefit plan, this is the mega plan. This is it. This is the ding, 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 we got them all. 401k plan, you're taking money from your wages, putting it into the retirement plan. It reduces what you're paying taxes on for your current tax return for that year. You've got the profit sharing. So, again, you get to put in some more money based on the profits coming out of the practice. And you put on the defined benefit plan, which is, again, funding for your ultimate retirement age. Now, in these mega plans, because you got the defined benefit in there, you have to fund it for at least 3 years. So you don't go into this for 1 year and stop. You have a 3-year requirement to fund it, and then you can freeze it. Okay, and then you could go back to the 401k and profit sharing or just 401k. But because you got the element of the defined benefit, there is a requirement to fund it for 3 years. The benefit, you can contribute $200,000 a year into this plan. It is the jumbo, put a lot of money in retirement plan. Now, of course, this is real cash we're talking about here. So this is a use of cash. We've got to make sure that you have the cash flow to do this. But the profit sharing and the defined benefit portion of this doesn't have to be done until September 15th of the year after you close your book. So for 2012, it would be September 15th, 2013. So you certainly have some time to put that money and get that money together, but it is real cash. So those are the type of plans. People always want to know, well, what are the options? And how do we do this? And how do you figure it out? A lot of it has to do with cash flow. Honestly, has to do with cash flow. So we have to look at what makes sense where your practice is now. Saving tax, but what makes sense to your lifestyle, to your debt, to what's going on with college funding, to the practice. We have to look at all of that, but we have lots of options. Well, time goes by, and suddenly you do have that epiphany, I want to be done in 7 years. Well, smart people find themselves scrambling around and plowing money into risky investments because you haven't made quite what you thought you should make or need to make to retire. And when you have unforeseen losses, you've got a bad retirement plan, a bad investment plan, which is no plan. It's no plan at all if you're trying to scramble and make up for past years. Smart people make bad assumptions, okay? If people that work for companies think my company's going to take care of me, government employees think, hey, I got it sweet, the government's going to take care of me. We found out in both those cases that's not so true anymore. You got cities going bankrupt. They're going to have to default on some of these promised pensions. They don't have the money. Now, business owners, dentists, I've had people tell me, I will sell my practice and I'm going to have enough money for retirement. Let me set you straight now. Your retirement plan is not the sale of your dental office. Your retirement plan is not the sale of your dental practice. It is a factor, but it is not your bucket of retirement money. So if you were thinking that, you are really far behind. It is not. It basically covers, depending on your lifestyle, 2 to 4 years in retirement for you, depending on what you can sell it for and depending on your lifestyle. So it is a factor, but it is by no means your retirement plan. So if that's what you thought, we have a lot of work to do. One bad assumption means you're going to work longer, It means you're going to have a different lifestyle in retirement than you ever hoped and ever wanted, and you're going to sell assets as well as your dental practice well below what you really would like to get for it. So wrong assumptions create angst, create stress, create the wrong plan. So, remember I told you fundamentals. We got there. Okay, our fundamentals were what's included in retirement planning. Lots of stuff, and things we need to go over. We need to start writing some plans and making you accountable to getting some of these things done. We talked about the fundamentals of what kind of retirement plans are there out there. People ask, what are my options? And we talked about mega ones. And we talked about how important it is that we still do this. Okay? And we talked about you can't wait, start early. So we got our fundamentals down. We talked about putting money away for different things. Don't commingle it because you'll never have enough money for the things you want to do.